because of policymakers and their tax cuts that surprised the markets.
Right. So a few things. Number one, the response by policymakers in the UK, the Bank of England getting involved, essentially was a bailout for BlackRock. And this reminds me back, when Gordon Brown was the Chancellor of the Exchequer, and he stole 300 tons of gold on behalf of the British people to bail out Goldman Sachs at that time. And here you have the Bank of England once again stepping in and bailing out a big Wall Street player. In this case, it's BlackRock. And the strategy, whatever strategy they're using, I can tell you that, number one, it uses derivatives in a reckless manner. And every time derivatives are used recklessly, there is a crisis, there's a failure, there's a counterparty issue, and they need a bailout. But the bankers over at BlackRock or the bankers at Goldman Sachs get paid on the volume of deals, not whether or not the deals make any sense or make any money. It's all deal volume. Volume pays. They typically make huge mistakes, and then they get bailed out, and then they get another payday. So it's in their best interest to just be as reckless as possible.
Right, because many pointed out that Chancellor on brink of third bailout for banks, of course, when the crisis was looking like it was going to be centered on the UK, perhaps it might be on Credit Suisse or Deutsche Bank, and next week, who knows? But the point is that we were having a crisis again caused by bankers and the derivatives products back in 2008. And when Satoshi Nakamoto printed the Bitcoin white paper on October 31st, and then, of course, the first block was mined on January 3rd, 2009. It was Chancellor on brink of second bailout for banks. So here at that time, it was caused by what was called, remember, CDOs. That was the word of the year, collateralized debt obligation. Now they're calling it liability-driven strategy. So there's always a new word for whatever the risk they have piled on to the global system. And as you point out, they received a bailout in this situation. BlackRock, of course, is entering the Bitcoin game, and wait until they find out that there's no bailout available in Bitcoin.
No, I mean, you make a good point there. The names of these products change all the time, but the underlying reckless derivatives composition of the products is the same. It reminds me of that scene in the great TV show in America called The Wire, where you see the peddlers of heroin would go around the street and call, hey, I got your WMDs, I got your WMDs. And every week or so, they would change the name of the heroin. It doesn't change the fact that it's basically the same heroin and it's killing people. Here you have Wall Street selling derivatives. They're the same derivatives. They're over-leveraged by 100, 200%. They're underlined by nothing except counterparty risk that's insured by bankrupt insurance companies. And it results always in the same thing, financial death. So nomenclature is important because it makes it easier to sell stuff to unwitting pension fund managers. In the case of the UK, their pension funds were under threat because the manager of those particular funds was completely incompetent, as almost anyone who runs a pension fund is incompetent. It's the very definition of what's called dumb money. The entire financial world is divided into smart money and dumb money. BlackRock and Goldman Sachs are smart money. They get paid no matter what. Pension funds typically are dumb money, and they're called dumb money on Wall Street, and those guys always end up eating a bag of worms.
Well, speaking of eating a bag of worms, of course, World War III is also not possible without a global beggar thy neighbor policy that was, of course, part of the global turmoil that led to all that period of World War I and II that we know. And now we have another global beggar thy neighbor policy. Partly it always arises to that moment, right? Because of the global setup with an all fiat currency of the US dollar. The situation is that the debts pile up in the US, inflation spirals, they need to raise rates, that causes the dollar to spike, and then all the global debts around the world, but also the developing countries, of course, their fragile currencies start to wobble and hyperinflate, and we see the crises that we see unfolding in Sri Lanka, Pakistan, where they can't get, goods like oil or natural gas, which is now, because a huge swathe of the market is unavailable, it's sanctioned. But on top of that, the dollar is sanctioned in a way effectively because there's a lack of liquidity because everybody wants dollars. So they're all rushing to buy these dollars. So we have a situation where, a lot of the third world, developing world is hungry right now. So into the fray, into this mix runs the UN.
Right. As we've been saying now for a number of years, there's two policy errors you can make. One is your interest rates are too high. The other is your interest rates are too low. Now, where was the UN 10 years ago, 5 years ago, when the central banks were coordinating a massive downtick in interest rates, even into negative territory, and moving trillions of dollars out of the pension accounts, savings accounts of mom and pop, of average people and the working class to fuel the bailout of the financial speculators on Wall Street? Where was the UN during that financial crisis that caused trillions of dollars worth of damage? Okay, suddenly in 2022, interest rates are high, and they're saying, oh, what about all this damage from the artificially high interest rates? Here's a message to the UN. Shut the central banks down completely if you want to eliminate these problems, and let the market decide, as it had been doing before central banks were invented. That's the solution.
Well, part of the issue is they're complaining about the end of a 50-year bull market and bonds. And this is something that, our show has been there for almost half of it, right? And the thing is that a lot of people out there won't know and understand is what that means. Like, interest rates were going down for the past 50 years, close to 50 years, down. And so all of that debt can keep on being rolled over and over and over. Once you hit the zero bound, which we did because of the last global financial crisis caused by the last fancy word called CDO, credit default swap. But they could get away with doing that, right? All for the past 50 years, because they could always repackage it into a new product with a new title, like this new latest one called liability derivative product.
That's exactly right. It's repackaging of the same garbage and calling it something new.
Yes. So, so they've been able to do that for 50 years. And now, because you hit zero, you reached a point where certainly the US couldn't go further. Germany, the rest of Europe could, because they didn't have the dollar, right? They had the euro, and they could trash their euro, they could trash their banks, and they had industry. When the US couldn't do that, they couldn't break the buck, they couldn't go under it. So we reached this point that was inevitable. It was always going to happen. Now, the question is, of course, as we reach this point, and as interest rates were at 0% at the beginning of this year and are over 3% now, that's a huge jump. 3% still sounds tiny, right? But it's like, that's a huge move, thousands of percent move sort of thing that you're jumping that far. So the question is, like, because our show has been around for so long and we've discussed this with so many brilliant guests for so long, that they've been predicting the end of the bond bull market and the beginning of a bear market. So the question is, like, will they turn to rolling it up into an SDR, into a global fiat currency? Will they roll it up into a CBDC run by the US? Like, what will they do next? Because obviously they have to roll it up into something if they want to maintain this sort of system of a debt-based system like this. Otherwise, obviously the people are going to go to Bitcoin.